Hello and welcome to the second installment of the Sector IQ Energy Update. Earlier this summer we released Sector IQ Energy, a new publication that explored and offered unique perspectives on the energy industry. In this video series, we are exploring how things have changed in the industry since the last issue was released. I'm Thomas Yeagle, VP of Market Development, and here with me is Jim Elder, a director in the Investment Management Group at S&P Capital IQ, focusing on fixed income. Jim, welcome. And in the last issue of the report, you had some commentary around CDS spreads versus S&P ratings. You identified some outliers and how things looked in general. How have things changed since the report was published a couple months ago?
Thanks, Thomas. Well, certainly some of those outliers still remain. What we can see here in this chart is a plot of the companies in the energy sector that have both a CDS and an S&P rating. You can see that the dots in blue represent the spread versus rating as of June 30th, and the series in red shows that as of August 18th, along with their best fit exponential trend lines. So overall, we can see that spreads have widened by about 13% on average and 8% on median after tightening during the second quarter. Several names have had very large movements, and I'll illustrate three of the largest. First, Forest Oil in the top right is rated single B- and trades at 912 basis points. That's up from 697 bips in June and down from 939 in March, so it's quite volatile. Second, one of the biggest outliers in the first quarter was Diamond Offshore Drilling. This continues to be an outlier at 102 bips relative to its single A rating. The next highest single A trades at about half that spread, or 55 basis points. If we look at Diamond through the lens of the CDS market-derived signal, which takes CDS spreads and translates them into lowercase quantitatively derived rating scores, it scores Diamond as a triple B- relative to its single A rating from S&P. That's a 4-notch difference. Finally, Peabody Energy Corp, trading at 406 basis points versus 344 bips at the end of the second quarter, is nearly 4 times its next closest rated peer within the energy sector, Kinder Morgan, which is rated double B. The MDS scores Peabody as a single B relative to the double B- rating of Peabody.
Thanks. So it sounds like outliers are still out there in most cases, with some slight widening of credit spreads from the CDS side of things. We didn't talk about it in the first issue of Sector IQ Energy, but yield curves are an interesting topic that we'll be including in future issues. What are they saying about the energy sector?
Sure. So we've seen the trends in the CDS markets. Now the cash markets are showing a little bit different story. Overall, yields for 10-year energy have fallen from 4.63% at the end of the first quarter to 4.12% now. The Z spreads, or the credit component of those yields, has dropped from 1.74% to 1.56%. That's about an 18 basis point improvement, which is similar in magnitude to the CDS market since the first quarter. But over this quarter, CDS markets have widened, as we just saw, whereas the cash markets, their credit component has largely remained flat. So we're seeing a little bit different trend between cash and CDS. The Z spreads in the energy sector are not reflecting the same movements as those within the CDS markets. Now they have more names that are trading in the cash markets than in the credit default swap markets, but some interesting trends to keep an eye on.
Thanks, Jim. And we'll see you in a few weeks for our next update. Also, if you would like to view the original publication, please visit www.spcapitaliq.com/sectoriq. Good day.